Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do every night here with our membership and going over each and every one of the trades that we made. Today was a very evenly spaced day as far as closing trades and opening trades. And one thing I'll mention here, and I try to tell people as they sign up for our 7-day free pass right now that we're offering, is that as we get towards the end of expiration, like you saw probably last week, that's when we start closing out some of the trades that haven't been winners, right? And again, our whole philosophy here is that with risk-defined trades, we're going to hold the trade as far as we can into expiration to let the probabilities work themselves out over time. So if we trade a 70% chance of success trade, we're going to let that trade work all the way through expiration if we need to until it shows a profit. Now, on the flip side of that, this is when you'll start to see us start taking off trades. So like tonight, all of the closing trades that we took off today were all profitable trades. And that's basically what we'll do from here all the way through the end of February expiration, and start taking off any profitable trades as they come up. If they don't become profitable and they're risk-defined trades, we're going to leave them on until the market has some sort of market cyclicality and swings back around and turns them into a profit. Okay, so again, I just want to make that point because it's a little bit confusing. People see a lot of trades at the end of the month that are little losers that we close out. But at the end of the day, we're making all these and closing all these profitable trades along the way as we get towards expiration. So I want to go over both the closing alerts and then also some of the new opening trades. You'll start to notice in some of these video tutorials that we've been doing over the last week or so that we're starting to roll our contract positions out to March if the pricing is good. So starting to get a little bit away from February. We're now inside of 30 days for expiration. So those contracts aren't as favorable, and we start moving towards March to give us a little bit more time, again, to let the probabilities work themselves out. So let's cover the closing trades that we had here today. The first was in IBM. Now, this one, a lot of people want to hold this trade all the way through expiration because IBM had a really, really bad couple of days on Wednesday, and then today again on Thursday. It's kind of gapped down. And so we'll go to the chart here. But here's what I told you guys about holding IBM. If you remember, the trade that we originally made was the 190-180 put spread, and we paid about $5 right around there for that debit put spread. Now again, we're paying the mid price for a debit put spread. So what that means is that we're paying basically, or making a basically 50-50 bet. So a 50% chance it goes up, a 50% chance it goes down. This is not a high probability trade because it's low implied volatility at the time. So with IBM, when the market gives us an opportunity like it did yesterday and today to exit this trade at a nice profit, you have to take that opportunity. So it's given us a nice little profit here, $143 per spread that you trade. That's a great little profit on the original 50-50 bet. And you start doing that consistently where you take these winners off of the table. Then it starts tilting your profit and loss statement. It doesn't become a 50-50 trade at the end of the day. So if you leave this trade on, that's your decision. You could probably get some more money, or maybe you might lose some money. But right now the market's giving you a profit. You got to take a profit on a 50-50 trade. So what we did here today is we closed out this trade by selling back to the market the 190-180 put spread for $6.58 in credit. So again, we sold that back to the market. We originally bought the put spread, sold it back. So let's go to the chart. Again, you can see exactly, we'll get to Netflix. But you can see that the market gapped lower. It gave us exactly what we wanted. All we wanted was that IBM would trade at some point between now and February expiration, which is this red dotted line on the right, that the market would trade lower, and you can see it gapped lower. So when the market gives you an opportunity to take profits like this, you've got to get out of that trade, right? Don't risk that the market could then come back up against your position. Don't be greedy and think it's going to continue lower. It might not. We don't know. So take that opportunity to take some profits off the table and move on to the next trade. All right, so the other one that we closed out here today before we get to Netflix is Tesla. We had sold a put spread in Tesla during high implied volatility, and Tesla's continued to run higher, and we bought it back for about 50% of the max profit. Again, exactly what we preach on all of the video courses and tutorials that we have here is with these risk-defined trades, you get to somewhere between 50 and 75% of max potential profit. You got to exit the trade and take the position off. So this was originally a very nice trade, I believe a 70% chance of success, and now that we've taken it off, we've banked the profit. So we bought back the 150, 145 put spread for a 70-cent debit. Originally sold it for double that and then some. So we made nice $72 profit per spread that you trade. Again, we go to the chart of Tesla. So why did we take the trade off now? Why was now the time that we took the trade off? Well, implied volatility is still high, and that's okay. But look how far Tesla's moved since we entered that trade. So right now we're trading right with the market. So again, don't get greedy and assume that it'll just continue going this way forever, right? At some point, the market's going to be a little bit more cyclical and it's going to come back and pull back. So at this point, it's given us an opportunity to make some money. We're making directional trades on both sides of the market right now. So when we have an opportunity to take some profits, you got to take the money off the table. And I know it can be a hard concept for some of you out there to learn, is to take this trade off the table. You see a nice big fat profit, but you just want to keep getting more. But you can't be greedy. Got to take money off. All right, so the last closing trade that we made today was on Netflix. And that's, we bought back the put spread on Netflix. This was just pure dumb luck with earnings. And again, I say that because there's really nothing to this. Netflix had great earnings. Sometimes it has bad earnings. Really just had great earnings and gapped major higher. So we bought back the 305-300 put spread for a 12-cent debit. I believe we're only in this trade for less than a week. $118 profit per spread. Again, the whole reason that we entered the trade on Netflix was because it had really high implied volatility, and you can see that implied volatility has all but collapsed completely down below that 50th percentile that we originally sold. And of course, the gap up that it had here today obviously helped. So again, don't try to squeak out that rest of that 12-15 cent credit that's left in it. Get out of the trade. Don't let Netflix have an opportunity to completely reverse this gap and come back down as we get towards February expiration. Take what the market gives you and get out. All right, so opening trades that we had here today, just a couple of vertical call and put spreads. Again, we're trying to be a little bit more directional with the market here to even up the deltas in our portfolio. So we got a little bit heavy on the put side, and that's okay because we started to make some money as the market kind of is going through some tough times right now, not exactly rallying all the way. But we also want to add to our call side delta, so adding some positive delta in case we do get a nice little rally here in February and March. So the first trade that we made was FCX. This was a directional trade. We bought the 33-34 call spread. Again, the width of the strikes with this debit call spread is $1. So we like to target about half of that in price. Paid 53 cents for this spread, or per spread here, so it's a little bit over what we want to pay at 50 cents. But that's okay. It's very close to it. And if you can get close to pricing around there too, that's good for you as well. If you look at the chart of FCX, you'll see exactly why we're trading into the call side. It's had just a couple of really terrible days after earnings. So because of this just huge move lower that it's had, it's conceivable to think that at some point between now and February expiration, again, that's all we're betting on, that it will trade above this line right here. And that's basically where we're trading this, is that we think at some point between February expiration, it's going to trade above where it's trading right now. So any opportunity, just like what we had with IBM where it traded lower, so any opportunity that we have where FCX trades higher, just even for a couple of days, is going to give us an opportunity to take the trade off at a profit. Now, why didn't we do a call spread or some sort of selling strategy, right? And if you take a look up here in the top left-hand corner, you'll notice that implied volatility is at the 10th percentile. So what that means is that 90% of the time, implied volatility is higher than it is right now. So if 90% of the time implied volatility is higher, that means that you won't want to do any type of option selling strategy. You like to go after some sort of at least option buying strategy, some sort of directional move in the market, okay? And that's why we made that directional trade, buying that debit call spread. So moving on to the Goldman Sachs trade. So we traded Goldman Sachs. It's been a little bit while since we traded GS. We bought the vertical 165-175 call spread, a little bit wider on this call spread, and that's just so that we could get some really good pricing and not have to dip into a lot of contracts. We only bought one of these, and we paid $5.43, so about $43 over the mid price of $500, which is the middle between the width of the strikes at $10. So again, same basic idea here with the Goldman Sachs trade, is that Goldman has been trading much lower. We're starting to come into some areas of general support. You can see it kind of bounced here today. You see this kind of low hanging wick on the candlestick chart. But again, Goldman has had a really rough past couple of weeks, and so we think there's going to be a little bit of market cyclicality. We're going to see a little bounce here in Goldman, and that's at least what we're planning towards. As a reminder, the reason that we decided not to go after a selling strategy where we're selling premium. Implied volatility is way too low. It's not above that magic 50th percentile that we talk about time and time again. All right, and then the last trade we made here today was a trade on bonds, TLT. We bought eight big vertical spreads, the 107, 106 put spreads. Again, paid a little bit over what we like to pay. The width of the strikes is $1 between 107 and 106. We like to pay about 50 cents on all of our debit spreads that we make, or about 50% of the width of the strikes. So in this case, it's about 50 cents. So paid a little bit over that, but that's okay. Again, same type of mentality here with the other ones that we traded here today, is that it just looks a little bit overextended. Usually when we start to see bonds get this overextended this quickly, look at this. We've had only 2 days of down moves in bonds in basically the last 4 weeks. So it's safe to assume that there's going to be some sort of cyclicality here, and people are going to start either exiting bonds, and bond prices are going to start heading back down. Yields will go back up. That's what we're playing towards right now. You'll notice that every time that bonds tend to make this type of move where they just have this kind of run up here the past couple days, it's very quick when they have their run up, but they also crash very quickly as well. So that's what we're playing towards here. Again, by trading just a straight debit put spread, then we basically draw our line in the sand right where bonds are trading right now and say at some point between now and expiration, bonds should trade below this line, giving us an opportunity to then make a profit. And that's what we're going to do. Close out the trade early as soon as we show a nice little profit here in this trade. So hopefully that really helps tonight with the new trades that we made. As always, if you're watching this video on YouTube, these trading alerts don't go out publicly to you guys on YouTube until about 5 to 7 days after. They go out to just our members at optionalpha.com. So if you want to get these trading alerts and not have any delays and checking out this video and these trading alerts, you got to sign up for a membership at optionalpha.com. Again, please ask all your questions right below in the comments section. I'll get back to everyone's comments tonight and tomorrow, and happy trading.